Hello everyone, Exam 2 Review Chapter 4. While the exam prep file is used in this video, I encourage you to prepare for the exam by also reviewing your VLNs, your homework, and the McGraw-Hill guided practice and extra practice problems provided. The Chapter Topics tab tells you exactly what you need to know from each chapter. We're focused on Chapter 4 right now, so you may want to stop the video at this time, look at the objectives to be covered, and then check them off as you become comfortable with your studies. The file also includes a summary of what we've done, financial statements for Buckle, and then we begin our Chapter 4 concepts. In Chapter 4, the first big thing was internal controls. I've shaded with blue the key areas that you need to focus on. With internal controls, the purpose is to safeguard company assets and improve the accuracy and reliability of the accounting information. Errors take place that are either accidental or intentional. If they're intentional, that's considered to be fraud. When we talk about fraud, we're talking about misusing company resources or manipulating financial statements, which is also known as cooking the books. The big law behind fraud management is Sarbanes-Oxley of 2002. It's also called SOX. It put reforms in place that allowed companies to better manage the risk related to fraud. The fraud triangle gives you an idea of why people commit fraud. They either rationalize it, they justify it, or they're motivated to do it because of something going on in their life, or the company just doesn't have enough controls in place, so it gives them the opportunity to commit fraud. As a business, we can most likely manage the opportunity by putting controls in place. And two of the key controls are separation of duties, where we have different people doing different parts of a task, and account reconciliations, of which a bank reconciliation is a perfect example. The challenge you have when it comes to fraud is collusion. When people get together to do bad things, it's difficult to catch them. The next key topic for this chapter was cash and cash equivalents. You need to know what makes up cash and cash equivalents. The key definition with cash equivalents is that they're short-term investments that have a maturity no longer than 3 months from the date of purchase. We'll show you some examples in a minute. Another important topic is to understand what we mean by cash receipts and cash disbursements. Cash receipts take place when we collect cash. So what does that mean? When we say cash, we're talking about actual bills that we carry in our wallet, receiving checks from people, accepting someone's debit card, credit card, or electronic transfers. Any one of those means that you will debit cash at the time the transaction takes place. Now, the one thing that you have to be mindful of is if we're accepting credit cards and debit cards, the credit card company or debit card company are going to charge us a service fee. So if we're talking about a revenue transaction where we provided a service to somebody or sold them a product, the cash that we'll collect from that transaction will be less than the revenue we earned because the amount that the debit or credit card company withholds from us is an expense to us that we'll refer to as service fee expense. When it comes to cash disbursements, we're going to credit cash. And again, what does that mean? We can pay with cash out of our cash drawers, or we can write a check or use a debit card. Those are all cash transactions. It's important that you know that if we use a credit card as payment, we're actually buying something on account and we've created a liability at that point that we'll have to pay off at a later time. So anytime we use a credit card, we credit accounts payable or some other title that we feel is appropriate for the liability we incurred. The next key topic is bank reconciliations. Bank reconciliations serve two key purposes. One, they provide an internal control for the safeguard of a company's cash. Two, they allow the company to determine the true cash position that they have at any point in time. When you do a bank reconciliation, you match the balance of cash in the company's bank account with the balance of cash in the company's own records, in its cash account of the general ledger. There'll be differences because of omissions. Sometimes you forget to do something, timing differences, and errors. Every company does bank reconciliations. Every person who has a checking account should do bank reconciliations. The table presented here gives you guidelines on how to make certain that you're doing your bank reconciliation appropriately. So I encourage you to stop the video here and review this table carefully. In a few minutes, we'll show you some problems. The final key objective for Chapter 4 was the Statement of Cash Flows. The Statement of Cash Flows is a financial statement that covers the period of time and reports all cash activities for the period. It tracks cash inflows and outflows from operating activities, investing activities, and financing activities. The only way an amount enters into the statement of cash flows is if it involves cash. The key components of the statement of cash flow are operating activities, investing activities, and financing activities. We've been covering these types of activities from Chapter 1, so you should be pretty comfortable with those activities. The key here is to look at transactions, classify them properly as either operating, investing, or financing, and then determine whether you have a cash inflow or outflow and the net amount for each category. Once you know the net cash flows for each of the three categories, you'll total them to get the change in cash for the period under consideration. You'll take that change, add it to the beginning balance in cash, and get your ending cash position. That ending cash balance will agree with the cash amount in your general ledger with your balance sheet, and with your bank reconciliation. We'll do a few problems in a few minutes. Just as important as understanding concepts is knowing the terms for the chapter. So I give you a nice exercise here, a matching exercise that allow you to confirm that you know the terms being used. Remember, to see the answers, all you need to do is unshade column A and you'll see the correct answers. There's no reason for you not to know the terms for each chapter covered. Now let's finish our review of Chapter 4 by looking at the Chapter 4 blue tab that has drills related to each of the concepts we've just discussed. The first two drills deal with cash and cash equivalents, cash receipts, cash disbursements. I'm not going to go through this in detail because you can look at these problems, move to the right, and unshade the answers to see if you're solving them properly. That'll take place not only for Chapter 4, but for every chapter in this exam. So in this case, we say that cash and cash equivalents include currency, credit cards, savings accounts, checking accounts, checks received, investments purchased with maturities of less than 3 months, commercial paper, debit card sales, certificates of deposits, money market accounts, 3-month treasury bills, and money orders. Those are all cash or cash equivalents. When we're talking about things like inventory, accounts receivable, investments that at the time of purchase had a maturity beyond 3 months, and things like accounts payable, those are not cash or cash equivalents. The second drill asks you to determine the revenue and cash received from a series of transactions. Again, we tell you that there's total debit card sales, total credit card sales, cash sales, check sales. We also tell you that if there was a credit card used, we are responsible for a 4% service fee. If our customers use their debit card, there's a 2% service fee. So again, you solve the problem, unshade it, and notice that the revenue earned was $1,500,000. The actual cash received was $1,480,000. The reason for the difference is that the debit card and the credit card companies or banks took their 4% and 2% of our sales. So these transactions never affect the revenue we report, but they will affect the cash we receive and the expense that we show on our income statement for service fees. Drills 3, 4, 5, 6, and 7 are all shaded with a blue color because they all focus on bank reconciliation. A good starting drill is 3. With 3, I give you a listing of reconciling items and I ask you to determine if those reconciling items affect the bank balance or the company's balance, and whether you'll add or subtract. I encourage you to look at the table in the concept section and then use that table to help you respond to each of these questions. Pause this video, do this drill, and look to the answers to the right. With number 4, 5, 6, and 7, I actually ask you to do some problems. I'm going to do number 4 and 6 with you. A company's general ledger shows a cash balance of $4,570. Comparing the company's cash records with the monthly bank statement reveals several additional cash transactions, such as checks outstanding, deposits outstanding, bank service charge, interest earned. The company also determined that it had recorded check 123 for its utility payment of $550 is $500. Calculate the correct balance for cash. To solve this problem, I've unshaded the answer. I'll take you step by step towards the completion so that you get a good understanding of the methodology you need to use when solving these types of problems. The first thing that you notice is that you're given the company's cash balance. The $4,570 is the amount in the company's cash account of the general ledger. Now adjustments have to be made. The first adjustment that has to be made is for the service charge fee from the bank. We have to reduce our cash balance by $110 because the bank has charged us for service. We've also earned interest during the period of $15. So the bank has already given us this interest. We need to record it. And then last of all, we need to recognize the fact that we made a mistake. The error on the utility payment is for $50. We wrote the check for $550 as we're supposed to, but when we journalized it and posted it to our ledger, we used $500. We need to reduce our cash position by another $50. Now we're also given information here on outstanding checks and outstanding deposits. These types of transactions only affect the bank side of a reconciliation. We're aware of all the checks we've written. The bank's not aware of $2,840. We're aware of all our deposits. The bank's not aware of any deposits that haven't been posted yet. So these two transactions would affect the bank side of the reconciliation, and because we're not given the bank balance, they're irrelevant to our calculation. In our calculation, we have a beginning cash position of $4,570, reconciling items of a negative $145, and a reconciled cash balance of $4,425. Our true cash position is $4,425. Our true cash position will be recorded in the general ledger once we journalize and post the service charge of $110, the interest earned of $15, and the correcting entry for the utility payment. Our cash position will be $4,425. Okay, now let's take a look at number 6. Number 6 says a company's bank statement shows a cash balance of $4,170. Comparing the company's cash records with the monthly bank statement reveals several additional cash transactions, such as checks outstanding of $2,110, an NSF check of $200, outstanding deposits of $1,000, interest earned of $30, service fees of $40, and a check for $150 recorded twice by the company. Again, we're asked to calculate the correct balance for cash. This time, instead of working with the cash general ledger account balance, we're working with the bank statement balance. So the relevant information at this point includes outstanding checks, outstanding deposits, and any error that the bank may have made. The beginning bank balance is $4,170. That's a given. Deposits outstanding, $1,000. We know that we always add outstanding deposits to the beginning balance. Checks outstanding are checks that we have written but haven't cleared the bank yet. Those checks have to be subtracted from the bank balance. The error that was made by the company, so the error has nothing to do with the bank side of the reconciliation. So our reconciling items are $1,000 in outstanding deposits, $2,110 in checks, for a total of a negative $1,110. Take our beginning balance on the bank statement of $4,170, subtract $1,110, and our reconciled cash total is $3,060. This is our true cash balance. So now you see that we were able to get the company's true balance two ways. In the first case, we worked with the company's general ledger cash account, found out all the relevant information that we needed to reconcile it, and got a true cash balance. In the second case, we did exactly the same thing, but this time we were given the company's bank statement balance. Again, we looked for the relevant information, found our reconciling items, and determined the true cash balance. I encourage you to look at these two carefully, make sure you understand them, then work number 5 and work number 7. The beauty of number 7 is it's a true bank reconciliation. By that, I mean it gives us both the bank balance as well as the general ledger balance and asks you to perform all the reconciling items needed to prove our true cash position. The final topic that we worked on in Chapter 4 was the statement of cash flows. The whole purpose of the statement of cash flows is to show why cash changed during the period by looking at the company's cash flows from operating activities, investing activities, and financing activities. Again, you're only concerned about cash inflows and cash outflows in those three activities. Problems 8, 9, and 10, and 11 should be done by you. You should look at each of those, be able to solve them. Number 12 is an excellent problem to do. In number 12, we make sure that you understand what transactions are included in operating, investing, and financing activities, and whether cash is flowing in or cash is flowing out given the transaction. I'm going to do number 13 with you. Number 13 says that a company had the following transactions during the year. Calculate the cash flows from operating activities, investing activities, and financing activities. Once again, I've unshaded the answers so that we can move through this in a timely fashion. Paid rent for 2 years is an operating activity. Anytime we're paying rent, That's for normal operations. Purchase office supplies on account, we're not going to include that transaction because there's no cash involved. And a statement of cash flows involves only activities where there's cash inflows or cash outflows. Number 3, purchase equipment paying $12,000 in cash and issuing a notes payable. Because we're purchasing long-term assets, it's an investing activity. Number 4, borrowed money from a bank. Anytime we borrow money from a bank, it's a financing activity. Paid employees' salaries, operating activities. Salaries are part of the daily operations of a company. Paid $2,000 on account related to transaction 2 above. So on 2, we bought supplies on account. We skipped it because there is no cash involved. In number 6, we're paying $2,000 of the $2,400 that we owe. So since we're paying cash, it's an operating activity because we're paying on account. 7, pay dividend to stockholders. Anytime we pay dividends to stockholders, it's a financing activity. So land for $10,000 that was purchased in a prior year for $7,500. Again, we're selling a long-term asset. It's an investing activity. We collect cash from our customers for services provided. That's an operating activity. So now, letter A says determine the net cash flows for each business activity. So the net cash flows for operating activities include the $8,000 outflow for rent, the $7,200 outflow for salaries, the $2,000 outflow for the payment of the accounts payable, and the $25,700 inflow from cash receipts from customers. We add these 3 up and we get a positive $8,500. That's why it's called net, because we're netting all the operating activity cash flows. When it comes to investing activities, we have 2. We purchase equipment paying $12,000 and signing a note for $4,000. So even though this equipment costs us $16,000, the only amount that goes into the cash flow is what we paid at this point. It's $12,000. When we sold land for $10,000 that we had purchased for $7,500, the cash flow is $10,000. It's an inflow because we're receiving cash. So the net cash flow for investing activities is a cash outflow of $12,000 and a cash inflow of $10,000 for a net cash outflow of $2,000. When it comes to financing activity, we borrowed $6,000, so that represents a cash inflow. We paid a dividend of $2,800, that's a cash outflow. So when we net the cash inflow and the cash outflow, we get a net cash inflow of $3,200. Letter B asks us to determine the change in cash flows. The net change in cash flows is the sum of the 3 activities. So we add the cash inflow from operating activities of $8,500, the cash outflow of $2,000 from investing activities, and the cash inflow from financing activities of $3,200. Our cash changed during the period by $9,700. If our beginning cash balance was $3,000, our ending cash balance is $12,700. This problem gives you practice with determining what's an operating, investing, and financing activity, calculating the net cash flow amounts, and determining the new cash ending balance. Well, thanks for watching this review for Chapter 4. I encourage you to review the concepts, the terms, and solve all these problems. Thanks for watching.